We're trying to build on yesterday's gains. We started out that way. We did reverse, though. Some of the economic data today wasn't great. It was a miss on the ISM services. There's the S&P down almost 0.5%. So, Josh, I'd love to get your take on where you think we are. HSBC today raises the target for the S&P for year-end to 6,400. They say their bull case is 7,000. Mostly because of AI-fueled optimism. We did have that below expectations ISM report. We're coming off the weak jobs report and the revisions. What say you about where we are?
Well, if we're going to get to 7,000, it's going to be because of the AI build-out. That is the only pillar holding up the U.S. economic growth story right now. Consumer spending has ground to a halt. The gains that we had been experiencing in the labor market for the last couple of years, despite higher rates, are now grinding to a halt as well. You look at ISM, really not a lot of great things in the commentary outside of CapEx spending, electrification, grid updates, all the things that we all already know. And I think that's okay because the stock market and the economy are not the same thing. I wouldn't suggest that they can diverge forever. But certainly, we could live through a period where everybody just gets accustomed to a slower pace of economic growth and services growth, and things are good, not bad, but certainly not at the pace that they were in, let's say, 23 or 24. And I think that's where we are. That being said, the companies that comprise all of the market cap in the S&P 100 and certainly the NASDAQ, that's where the earnings growth is happening, and it's almost happening sort of on its own timetable and on its own track. Mm-hmm. So I think all of these industrial stories about grid build-outs and data center build-outs, like all of that is going gangbusters. You can't deny it. You hear it on every single call. Everything that has to do with cloud computing and data center, it's on fire. And is that enough is really the only question, and will the consumer hang in there? Until we get a growth driver for them. So I'll finish this by saying there is a growth driver out there for the consumer. It's when the Fed starts to cut rates, mortgage rates meaningfully change, and all of a sudden we get a little bit of life back into the cadaver that is existing home sales, and we start to see a housing cycle. I don't know if that's at Fed funds 4.5%. It's probably lower than that, but that's the big thing out there that will be a game changer for the middle class and to see a resurgence in services spending. Until that happens, you really have to rely on mega cap tech and the industrials that are benefiting from the CapEx numbers they continue to ratchet higher. It's okay. We probably can. Not definitely. But if you're rooting for a great finish to the year and a 7,000 S&P target, that's the only way it's going to happen.
Yesterday, Joe, smacked of rate cut optimism. The market was up big. You got the Dow getting all of its Friday losses back. The Russell was the outperformer, the thing that would jump the most if you were obsessed about getting more rate cuts than you thought just 1 week ago. Today smacks of bad news is bad news. I mean, here we are wondering, okay, what is the state of the economy? What's the Fed going to do about it? Can they even do anything about it? So we're in a historically choppy period. August is a nothing burger in terms of performance. July's always pretty good, and September seems to be pretty bad. And here we are in this period of time where we have significant questions that need to be answered.
So you have to set an expectation. I think that expectation relies on being somewhat patient here. You're going to have to be patient towards the end of the month. Will Jackson Hole be the moment in which the Federal Reserve telegraphs that a rate cut is coming in September, which I agree with Josh will have a positive effect on, most importantly, the wealth effect. It will stimulate the housing market, and that's important right now as a catalyst. But until then, look, I'm just looking at a chart over the last 2 weeks, and you can see clearly the last 3 trading days, we've had an expansion of the bars. We've had widening of the trading ranges. It's elevated volatility. It's classic August environment. And in that type of choppy environment, to borrow the word that you're using, I think it's important that you understand your position sizing needs to be small, because I don't think we resolve this big question surrounding Fed rate cut or not until the end of the month.
Yeah, Anastasia, I'm not sure the market really is convinced of anything. You know, Gundlach told us yesterday when we talked to him, he thinks 2, maybe 3. But I'm not sure the market really can make up its mind as to when it thinks it's going to get cuts. There are some firms on the street that still think you won't get any,
right,
because inflation is going to remain above target, and that's going to be the concerning factor for the Fed, even if the labor market continues to look a little more dicey. Now, there is a decidedly different point of view that says labor market, they're going to err on the side of caution first. And the first real sign, now the revisions notwithstanding, that they're going to cut rates because they're not going to wait around.
Look, I agree with that sentiment, Scott. And when you think about what Fed Chair Powell said last week, is he really talked about the one-off increases in inflation due to tariffs being a one-off. He talked about, looking at the 1 year and beyond inflation expectations and really not seeing much in terms of higher inflation expectations over, let's say, a five-year period. So I do agree with you, Scott, that he really cited the labor market weakness as something they're cautious about, and they do see downside risks that are also apparent. So to bring it back to the point of market choppiness, I agree with the sentiment here. This is a choppy period of time, and I think this is a quarter of adjustment to higher tariffs, which is now everyone's base case. And at the same time, also the quarter of adjustments to lower rates. And I think we'll see this sort of price action because some days we're going to react to the fact that, for example, Caterpillar had to take 1.3 or 1.5 billion hit to earnings because of tariffs. So we have to price that in, which means lower margins. And on the other hand, when you do get a services ISM number, which is weaker than expected, you start to ratchet up the rate cuts. So the base case for me is choppy price action until we get to that September meeting, which is not until September 17th.
You still feeling a correction's coming?
I'm going to change the term because correction is down 10%. I don't think we'll get 10%, Scott. I do think we'll get that full 5 to 7% from the high. And I don't think that's much of anything. I think it's going to be catalyzed by exactly what we're talking about today. The ISM services miss. I said this yesterday. We just can't afford it in this environment. And who knows? The next kind of macro data that I'm looking at is Thursday's jobless claims. Those have been very quiet. You just don't need a spike there. That's the sort of thing that could move the market lower. But let me be clear.
Didn't you really zero in on today's number yesterday?
Yeah.
You said it was one of your focal points, given that we're 2/3 of a service-based economy.
And frankly, I'm surprised we're not down more. I am. But there are reasons, there are positives out there. I mean, let's not forget that GDP is growing. Now, many of us will say, yeah, that's because of inventory adjustments. That's because of trade fluctuations around tariffs. But GDP is still growing. More importantly, profits are growing. Second quarter earnings are now looking like they're solidly in double-digit year-over-year growth. Remember, that was expected to be around 4.8% as we started the quarter. Why does this matter? It matters because if profits are growing, companies don't want to lay people off. They're clearly not hiring. We see that in the continuing claims, but they don't want to lay people off. If they can just get more crystallization about what the tariff picture will actually be, then they can lean in, particularly when the Fed cuts rates. I'm going to come out and say this. I definitely think the Fed's going to cut in September. A little bit more provocative. Joe, I get your point. I just don't think the market needs to wait to accept that to Jackson Hole. I think the market's accepting it now. That's why it's not down more.
Well, we'll see. It may want some confirmation, and it may get it at Jackson Hole if the chair uses that platform to set the table.